Welcome to the John B. Levy and Company podcast. I'm your host, Rick Young. John, good to see you again.
Nice to see you, Rick.
In light of the current market conditions, John, what's your opinion of Fannie Mae and Freddie Mac?
Well, there's an awful lot of politics going on there. I don't think there's any question that Fannie and Freddie are going to be smaller when this is all done. But right now, cutting the housing part of Freddie and Fannie doesn't seem to be a really good idea. The housing market is weak enough already. What does make sense to me, and what I think we're going to see, and we're already actually seeing it by the market, is a smaller Freddie and Fannie with multifamily. For example, 2 years ago, you could have made the argument that Freddie and Fannie, at the height of the liquidity crisis, probably had 80%, if not more, of the multifamily market. Today, it's less than 50%. So what that's saying is that the third party, the independent, the private market, is reclaiming part of the multifamily section, which is what they should have, and Fannie and Freddie are getting smaller. Now, to say that they're small is not quite true, because Fannie and Freddie's portfolio is probably well over $300 billion. So they're going to be a huge multifamily player. But I think politically, it's going to make sense for them to be smaller players, eventually in single family, but probably now in multifamily. The one exception that I'd bring up is I think Freddie and Fannie are going to have a continuing, ongoing role, not reduced, in low-income housing. It's very hard to get the private market to effectively price and buy into low-income housing. So what's going on? Kind of a lot, but really the big story at Freddie and Fannie still is very, very weak single-family sales and resales, even as late as today.
What do you see as the best markets for investment right now?
Well, Rick, it's really interesting. I kind of look at the investment market as if you're throwing a rock into a pond. And, the first thing you see is that big splash. And those are the 5 or 6 markets that you could buy in last year, the Bostons, the Washingtons, the New Yorks, the Chicagos. But now what's happening is we're seeing these concentric circles, just like you see in a pond, and we're spreading out. And there are probably 20 or 25 markets that capital is interested in going to. And it's interested in going there because the price in the top markets has gotten so expensive that in order to get the yield they want, they've had to go to other markets. For example, we've had success, significant success, raising both equity and preferred equity in some of these second and third tier markets, including the Rust Belt. Now, a year ago, that would have been impossible. But right now, there are people that are saying these are good opportunities, especially relative to these big core markets, basically the coastal markets with the exception of Chicago, that we've been in. They're just priced too thin for the returns that we need.
Now, John, we've talked about CMBS in the past. What about the institutional part of the business?
Well, it's on fire. CMBS is going to have a decent year for sure, probably $40 billion. Some might say 50. We doubt it. But don't forget, it was only $10 billion last year. But the insurance companies, the pension funds, they are literally in a sprint to put out money. My guess is that from a low of probably $10 billion, they may put out $40 to $50 billion of their own this year. So they're running on all cylinders. Insurance companies are really trying to get the cream of the crop, the best deals. They're willing to price them effectively to get them. But I think if you said how are they doing, they're in a race and they're running on all cylinders.
Obvious question, is money on sale?
Yeah, money's definitely on sale. I mean, this is one of these times when you want to say you ought to back up the truck and take all they'll give you. Because if you look at 10-year money, 7-year money, fixed rate money, it's 4.5% to 5%. I mean, that is a screaming buy. So I don't think you ought to really play around with, could it be 4 3/8 as opposed to 4.5, or could it be 4 75 instead of 5? The answer is money's on sale. This is the time that you'll look back in a year or two and say, gee, I'm glad I borrowed as much as I could, I fixed the rate, and I took liabilities from the owner's point off the table. So yeah, this is a screaming buy right now.
As always, great advice. Thanks, John.
Always a pleasure, Rick. Thank you.
Next time on the John B. Levy and Company podcast, the Labor Day forecast.